two of the world's largest holders of U.S. government debt, China and Japan, have offloaded a staggering $113 billion worth of treasuries in the third quarter, just before the U.S. presidential election.
And China's pulled back as a buyer. Japan has pulled back as a buyer.
China and Japan have not over many, many years been huge buyers.
Before we start the video, make sure to like, comment, and subscribe to our channel for more interesting videos.
So why are major buyers fleeing the treasury market? What's the impact on yields and the economy at large? And just how can investors best navigate the market going forward?
Japanese investors, in a record-setting move, sold $61.9 billion of U.S. securities in the 3 months ending September 30th. This isn't just a small adjustment. It's the largest sell-off of U.S. bonds by Japanese investors ever recorded. On the other side of the Pacific, Chinese funds weren't far behind, offloading $51.3 billion during the same period. For China, this marks their second biggest sell-off on record. The timing of these sales is crucial. They happened in the third quarter, just before the U.S. presidential election that saw Donald Trump secure victory and the Republican Party gain control of both houses of Congress. It's a period that saw U.S. Treasury yields reach a 2.5-year high in mid-September, signaling growing uncertainty in the market. After the election results were announced, we saw Treasury securities drop almost 4% in value. This decline wasn't just a knee-jerk reaction to political change. It reflected genuine concerns about President-elect Trump's proposed economic policies, particularly his promises of low taxes and high tariffs. Many market analysts fear these policies could fuel inflation, leading to a decrease in the value of existing bonds. Shoki Omori, chief Japan desk strategist at Mizuho Securities Company in Tokyo, offers valuable insight into the mindset behind these sell-offs. He states, "It's a cocktail of banks and pensions selling ahead of the U.S. elections in Japan. The risk of a Trump win and expectations of higher U.S. yields bruised sentiment for the bonds. Even more so in China, where geopolitical risk was a real concern, and that spurred investors to ditch treasuries too." Omori's analysis points to a complex web of factors driving these decisions. For Japan, it wasn't just about the election. Their sell-off may have been amplified by strategic moves in the foreign exchange market. On July 11th and 12th, Japan's Ministry of Finance sold dollars to buy yen, totaling an enormous 5.53 trillion yen, approximately $35.9 billion. This intervention in the currency market likely played a significant role in their decision to offload U.S. treasuries. The story becomes even more intriguing when we look at China's approach. Their strategy for selling off U.S. debt appears more nuanced, possibly involving the use of custodial accounts. Interestingly, funds in Belgium, often seen as a home for such accounts, bought a record $20.2 billion of treasuries in September. This unusual activity raises questions about whether China is using these accounts to manage their treasury holdings more discreetly. Despite these significant sell-offs, it's crucial to maintain perspective. Both Japan and China still hold enormous amounts of U.S. debt. As of the latest data, Japan owns $1.02 trillion worth of treasuries, while China holds $731 billion. But what's driving this shift? And what does it mean for the future of U.S. debt financing? One key factor is the uncertainty surrounding Trump's economic policies. His campaign promises of significant tax cuts and increased infrastructure spending, if implemented, could lead to higher budget deficits. This prospect, combined with his rhetoric on trade policy, has many international investors concerned about the future value of U.S. debt. Nick Twidale, chief analyst at AT Global Markets in Sydney, summarizes the situation precisely. "We're confirming everything we've started to price in, that Trump's likely going to have inflationary policies, tariffs, and that's going to only lead to more treasury sales from China and Japan. They've been good defensive measures by China and Japan, and that's probably going to continue." Twidale's analysis suggests that we might be looking at a new trend rather than a one-off event. If Japan and China continue to dump U.S. treasuries, what impact will this have on the U.S. economy and global financial markets? To understand the potential consequences, we need to consider the role U.S. treasuries play in the global financial system. U.S. government debt is often considered one of the safest investments in the world. It's the benchmark against which other investments are measured, and it plays a crucial role in setting interest rates across the global economy. A significant sell-off of U.S. treasuries by major holders like Japan and China could lead to an increase in supply in the bond market. Basic economic principles tell us that when supply increases, prices typically fall. In the bond market, lower prices mean higher yields. Higher yields translate to increased borrowing costs, not just for the U.S. government, but for businesses and consumers as well. This dynamic could potentially slow economic growth. If borrowing becomes more expensive, businesses might delay expansion plans, and consumers might think twice about taking out loans for major purchases like homes or cars. Moreover, the sale of U.S. treasuries by foreign holders can affect the demand for the U.S. dollar. If demand for the dollar decreases, we could see a depreciation of the currency. While a weaker dollar might make U.S. exports more competitive on the global market, it could also lead to inflationary pressures at home as imported goods become more expensive. Perhaps the most concerning aspect of this sell-off is what it signals about confidence in the U.S. economy. Large-scale selling of U.S. treasuries by major foreign holders could be interpreted as a lack of faith in the U.S. government's fiscal health. This perception could lead to increased volatility in financial markets and raise concerns about the sustainability of U.S. debt levels. For the incoming Trump administration, these developments present significant challenges, particularly in the realms of fiscal policy and international relations. If foreign investment in U.S. treasuries continues to decrease, it could lead to higher interest rates, making it more expensive for the U.S. government to borrow money. This complicates Trump's plans for expansive fiscal policies such as tax cuts and infrastructure spending. The administration might need to attract alternative investors, which could necessitate offering higher yields, further escalating borrowing costs. It's a delicate balance. If the Federal Reserve responds to higher interest rates with monetary tightening, it could slow down economic expansion. On the flip side, a weaker dollar resulting from reduced foreign demand for treasuries might boost exports, but also contribute to inflationary pressures, further complicating the administration's economic objectives. It's also worth considering the geopolitical implications of these treasury sales. The actions of Japan and China in reducing their U.S. treasury holdings may be influenced by their responses to U.S. trade policies. Trump's stance on trade, including his views on tariffs and trade agreements, could further impact these countries' investment decisions. A strained economic relationship might lead to retaliatory measures, affecting global trade dynamics and the administration's foreign policy goals. To fully grasp the significance of these events, we need to consider the historical context. The relationship between the U.S., Japan, and China in terms of treasury holdings has evolved significantly over the past few decades. Japan has been a major holder of U.S. treasuries since the 1980s, a period that saw significant trade surpluses with the U.S. These surpluses were often reinvested in U.S. government debt, creating a symbiotic relationship between the two economies. The recent sell-off marks a departure from this long-standing trend. China's relationship with U.S. treasuries is more recent, but no less significant. China began accumulating large amounts of U.S. debt in the early 2000s as its export-driven economy generated massive trade surpluses with the U.S. By 2008, China had surpassed Japan as the largest foreign holder of U.S. treasuries. However, since reaching a peak of $1.3167 trillion in November 2013, China's holdings have been on a gradual decline. The recent $51.3 billion sell-off is part of this larger trend, which has seen China's treasury holdings fall by 44% since their peak. This shift in China's approach to U.S. debt holdings reflects broader changes in its economic strategy. In recent years, China has been working to internationalize its currency, the renminbi, and reduce its dependence on the U.S. dollar. The country has also been diversifying its foreign exchange reserves, investing more in gold and other assets. The implications of these shifts extend far beyond the world of finance. They touch on issues of geopolitical power, economic sovereignty, and the future of the global economic order. For Japan, the recent sell-off raises questions about the future of its economic relationship with the U.S. As a key ally in Asia, Japan's economic decisions carry significant weight. Will this move signal a broader realignment of Japan's economic strategies, or is it a temporary response to market conditions? The U.S. Treasury market, valued at a staggering $26.5 trillion, is at the heart of this unfolding drama. It's the largest and most liquid bond market in the world, and changes in this market can have far-reaching consequences for the global economy. To put the size of this market into perspective, U.S. Treasuries account for over 42% of the Bloomberg Aggregate Bond Index, which is widely considered to represent the bond market as a whole. This dominance underscores the critical role U.S. government debt plays in the global financial system. The Federal Reserve, while not directly controlling Treasury yield levels, plays a crucial role in influencing the market through its actions on short-term borrowing rates. As one market analyst noted, that's another thing that we've seen consistently over the past year and a half or so, that as the Fed has raised its benchmark borrowing rates, say by a quarter point or half a point, the Treasury market has generally followed in kind. If the Fed's going higher, bondholders generally say, okay, we want more yield as well.